And our concept of today is that we want to learn how we can predict corporate failure, which you'll find that it will be a very key concept, even when it comes to practice. So you'll find that at times predicting corporate failure might be a very complex task. That one you can agree. Where in this case you'll find that it's going to involve aspect of financial analysis. You'll find that it's going to involve aspect of us analyzing economic indicators, and probably also using some of our qualitative basically factors. So you'll find that at this point there are some various models which have literally been developed to help us at any given point whenever we want to predict this corporate failure. There are guidelines and models that we will be expected to use. So in this case, we find that these models are divided into two components. That is a quantitative models and a qualitative models. So if we can analyze a bit of our quantitative, let us have a look at them first of all. Quantitative models. Let us have a look at, first of all, we can have a look at some of them first of all. Then, of course, you can jump deep and consider them one by one. So in the quantitative models, of course, we are going to start with the one which is very common. I know majority of us, you are very familiar with it. And that is, of course, the Altman Z-score model. Altman Z-score model. These are the first one. Number two, we normally tend to talk about Spring-Gate model. Spring-Gate model. Number three, we normally tend to talk about Farmer model, right? And you know here, there are some models that you find them to be very new, which is okay, because it is good for us to learn, right? You'll also find that we'll be talking about number four, what we normally refer to as Zimijeski model. That is a Zimijeski model. Zimijeski model. Zimijeski model. Number five, we'll be talking about Z-score model. We have a Z-score model. And also talk about Tafler model. Tafler model. So you'll find that all these are amongst, we've not listed all of them, just a few, right? You'll find that these are some of the models that at any given point, whenever we want to predict our corporate failure, in this case, you'll find that we'll be using what these are, of course, financial distress, right? We'll be using this basically what these models, very, very important for us. So looking at that case, you'll find that we'll also be talking about qualitative models here. Of course, our focus will be one main, which I know majority of us you're very familiar with. And this case, ideally, we normally tend to talk about what Argenti's model, right? You've heard of Argenti's model. That's what we're going to talk about here. These are basically Argenti model. I know majority of us are very familiar with that. So you'll find that by the time we are through with this class, it will be very important for us to basically understand these models and how we are going to use them in practice, as well as how we are going to use them for the purpose of our examinations. So once we are through with this, I think we'll be very comfortable. And to that point, I want us to jump straight and start with the first one under quantitative models, which is Altman's Z-score model. These are models that I want us to analyze in this class of ours today, so that you should be able to understand it clearly. And you'll find that predicting corporate failure or talking about financial distress in any company is always a very interesting concept. If at all you open your mind wide, you'll find it to be very, very interesting. Okay, so once Molimu has mentioned that, then I want us to basically jump into the quantitative models, and we're going to start with the first model, which is what? The Altman's Z-score model. So we start with the first one, which is the Altman's Z-score model. Yeah. Altman's Z-score model. Altman Z-score model. It's a very interesting model because you'll find that actually this was developed to basically predict failures in manufacturing companies, which if we dig deep into it, you'll understand it more clearly. So understanding basically the Altman Z-score model, you'll find that this is a model that basically was developed some times back, that is 1968, right? If I was to give you a history, but that is another story. So you'll find that this model is important because we normally tend to use this model to predict the aspect of bankruptcy or financial distress in a company. So we normally tend to use this model to predict, number one, the aspect of what? Financial distress or bankruptcy in a company. So this is used to predict financial distress or bankruptcy, of course, in a company, or bankruptcy, about the bankruptcy in a company, right? Very important to understand. And you'll find that key element that we should also be able to understand here, that this model is based on the combination of various ratios. So that is also very key to note. We're just picking some key points that Z-score model, you'll find that is a combination of financial ratios. These are simply a combination of financial ratios that we normally tend to use. Combination of financial ratios, right? That will enable us basically to understand this concept into a deeper perspective. And you'll find that after we are using these ratios, we're going to assign a certain numerical score to a company. In this case, we're going to assign a certain numerical score, of course, to a company, And this score literally is now what you're referring to it as what? As Z, right? Because if at all you can recall the whole concept of score in any form of company, you can basically have in mind what basically, if at all you've dig deep into finance, you can basically recall these scores that you normally tend to talk about. So I know this one is not at this level, but if you go deep into finance, you'll find that anytime you're talking about financial distress, we normally tend to talk of basically these scores. We normally tend to talk of the aspect of Z score here, which majority of us are very familiar with. We normally tend to talk of a score that we normally term it as basically the X score here. Talk about X score. Literally, these are per the, of course, Zimiewski, right? We've talked of who Zimiewski is. And of course, we normally tend to talk of the last score, which is basically H score, right? Remember the H score? H score, basically, this is as per, of course, one that we're referring to as a farmer model, right? That is, of course, the farmer model. So these are the scores that, of course, we normally tend to assign to the companies, and each will be having its way of predicting. So basically, this is if you dig deep into finance, you'll find that we'll be talking of these scores. But anyway, this was just by the way to enable us to understand the whole of these concepts. Okay. So once we are able to of bankruptcy, the lower risk of bankruptcy, and the lower the Z score, and the lower the Z score, okay, the lower the Z score, the higher the risk. The higher the risk of bankruptcy. So these are some of the specific items that we must always tend to pick if at all you are to understand the whole concept of Z score. Okay. So one thing which is very important at this level, which I want us to analyze it clearly, you'll find that at this level for Z score, it uses 5 financial ratios to assess the company's financial health and stability. So it uses the 5 financial ratios. It uses our 5 financial. It uses the 5 financial ratios. So here you are saying that another key element that you should be able to understand is that Z-score uses 5 financial ratios. Uses 5 financial ratios, basically to analyze the financial health of the company, to analyze the financial health of a company. And these ratios, basically, we normally use these short form or maybe an acronym which will always assist us. Talk about WAREMAS. Talk about WAREMAS, right? A very key element that will be assisting us to understand this case. So before we jump to WAREMAS, I think it is important for us then to understand the score first of all. After we've understood the score, then we can go ahead and analyze this aspect to do what? To do with these ratios. So ideally, for us to determine our score, the bankruptcy score, which we are going to refer to it as a Z-score, Z-score will always be represented, of course, by, that is, of course, these are an equation that we'll always be able to use. So we normally tend to talk about 1.2 x1. We add 1.4 x2 plus, of course, 3.3. That is, of course, x3. I know you are understanding that we are talking about x1, but at times, Mwalimu, there's a one point where one had asked Mwalimu, what if we use basically what? What if we use A, B, and C? Will there be an issue? There won't be an issue, right? Because these are just literally to guide us. So plus basically 0.6 x4, and of course 0.99 of course x5. So these are what, or rather, fraction that we normally tend to use. Remember at this point, Mwalimu is saying that this is 0.999, or rather just 1, because it will always equate to 1, right? At times, once a student asked that, Mwalimu, what if I use A, B, C? Will I be penalized? No, so long as you know all the factors in case, right? You can as well use 1.2a plus 1.4b plus 3.3c plus 0.6d plus 0.999 or 1. Actually, don't, this case you can as well use what? 1, because it's just only the same. Talk about 1. E. Okay. So this is very important for us to be able to understand, right? That is very important for us to be able to understand. So the first thing that we should be able to understand here, that in this structure of ours, like when we are talking, of course, of our score, the first element which we are referring to as x1, which we are referring to as x1 here, you'll find that it will be very easy for us to be able to understand that. And why is Mwalimu saying that? Because you'll find that x1, these are basically, of course, working capital to total assets ratio, WAREMAS, right? We are referring to it as WAREMAS. So here, this is x1, which in this case, these are working capital, WAREMAS, right? Working capital, have it as working capital, WO, right? WO, term it as a WO. So literally in this case, I'm having X1, which is a WO. At this point, ideally, we are talking of our working capital to total assets ratio. These are working capital to total assets ratio. Working capital to total assets ratio. To total assets ratio. So you'll find that this point, my good student, X1, it measures basically the proportion of a company's total assets that are financed by its working capital. And remember, these assets also includes the aspect of what? Working capital, which includes current assets and current liabilities, right? Working capital. Remember the old concept of working capital. You take your current assets, you deduct your current liabilities. So it measures, basically, we say that at this point, you're saying that it measures, very important, it measures the proportion of companies' total assets that are financed by its working capital. So that is what we're referring to as what? Working capital to total assets ratio. X2 here, we can talk over X2, which in this case is retained earnings, retained earnings. So X2, simply here, we are looking at it as it reflects basically the proportion of companies' total assets that have been financed by its retained earnings rather than the external funding. So you'll find that at this point, ideally, we normally tend to talk about our retained earnings over total assets. So retained earnings of our total assets, retained earnings of our total assets. Retain our total assets, okay? So that will take us to X3. X3, at this point, my good students, we are referring to it as an aspect of, basically, in this case, we can refer to this as E, right? E. In this case, you can take it as R, so that you should not confuse. E. So what is E, or rather what is basically aspect of X3 here? You'll find that at this point, it basically evaluates the efficiency with which the company's total assets are generating operating profits. That is very important to know, that it evaluates the efficiency with which the company's total assets are generating operating profits. So ideally here, we are talking of our earnings before interest and tax. Earnings before interest and tax, we divide by our total assets. See, and that's why Mwalimu is very specific when we are saying that it simply measures the efficiency with which the company's assets are generating operating profit. That is very important for us to be able to understand. Then we're having basically X4. X4, simply, we are talking of MA, M-A. We're talking of M-A, MA. So what is this context here? MA. MA is simply the market value, my good students, where you'll find that it compares the market value of a company's equity to book value of its total liabilities. That's simply indicating what? The investor's what? Sentiment. How will people perceive us? So in this case, we're talking about the market value of ordinary shares. Market value of ordinary shares. Market value of ordinary shares. Okay. We are going to divide all this by, that is our market value of ordinary shares. You're going to divide all this by the total liabilities here, total liabilities, of course, including what? Including our preference shares. Total liability, including our preference shares. Very important to note. Then this should take us to the last, basically, aspect of ratio, in this case, mass, right? So at this point, basically, we are talking of it as a basically aspect to do with the sales to total assets ratio, because we want to basically measure how efficiently a company is utilizing its total assets to generate the sales revenue. So simply in this case, you'll find that we are talking of our sales divided by our what? Total assets. Total assets. You see how simple that is, right? So all these are the ratios that we normally tend to use, and that's why we normally tend to talk about what? Waremas, right? Waremas. And the beauty part is that you don't need to struggle with all this, because as at the end of the day, you'll find that the examiner will always tend to guide us in relation to these ratios. So it is important that you should not struggle, or you shouldn't be like Mwalimu now. How will I grasp all this? This is very simple. You'll always be given this context, right? So after we have understood basically what Warre mass entails, and therefore aspect of our ratios as per our Z-score, it will be very important for us to have a look at a question which now will enable us to cement this concept very, very well. It will be very, very important for us to look at a question which will enable us to cement this concept very well. So once you have that, basically that should take us to our question, which was attested. That was December 2022. So I'm sharing the question with us here. This is our question here. I've shared with us that question, believing that it's very visible. And as Mwalimu has mentioned that many times, of course, you'll always be given these ratios to use. So you don't need to struggle that much, right? You don't need to struggle. You don't need to struggle that much. So, believing that we are all in that question, it was a very good question. Question number, that is, of course, December 2022. Question number, that was question number 4. December 2022, question number 4. Question number 4. December 2022, question number 4. So the first bit in that question, we are told, examine 4 stages that a company might go through during restructuring. And that is very important. The beauty part is that Mwalimu had given us this. Recall this, what we did. Recall this. Let me share. I remember basically I gave you this when we were looking at all these aspects, the stages, and I literally explained them. Remember this video? Right? Remember this video? It was our first class when you were introducing aspect of restructuring. Look at the steps. I gave you the steps there. I gave you the steps anytime you're considering what restructuring. So basically, I'll wish you to refer to that video. That was our first video when you were starting. So I'll wish you to refer to this video. I gave you the steps which you're having them. Okay? So back to our question here. We are told part 2 of the question, that is our area of interest, that the Altman formula for prediction of bankruptcy is given as follows. That's why Mwalimu is saying that many times we'll always be given that. I'm having Z score to be 1.21, x1, 1.4, x2, basically 3.3. I'm having 1 and 0.6, right? So, on that case, you're told that where working capital, total assets, x1, x2, retained earnings, total assets, x3, earnings before interest and tax to total assets, x4, sales to total assets, x5, market value of equity to book value of debt. And you are given 3 companies. So a good examiner wants us to determine the Z score for each of the 3 companies, and you are supposed to comment on our results that we've determined in one above. So given such a question, my good students, do you really need to struggle? Surely. We have everything. Our task will just be a matter of copying and pasting. And the good thing is that our good examiner also here has given us the aspect of the score and how we are supposed to use it clearly. So you don't need to struggle in that question at all. So these are what you're going to do These are what you're going to do in that question. December 2022, question number 4. December 2022, question number 4. Take your time, have it. Take your time, have it. Take your time, have it. I think I'm going to do like a one company, then I'm going to leave the other one for you to handle it because it's just the same. Just the same. So in this context, we start with company A. Start with company A. So let me squeeze this question down here. You'll find how easy this question is as at the end of this all. So the first thing we need to come up, of course, with whichever equation that our good examiner has given us. Our good examiner has told us that this is how we are going to determine our z-score. We use what he has given us, right? So I'm having basically 1.2 x1 plus 1.4 x2 plus 3.3 x3 plus 1 x4 plus 0.6 x5. So we use what he has given us. We use what the examiner has literally given us. So in this case, we need to basically work out for this company of ours. We are given basically 3 companies. So we start with x1. I'm having company A. We can do them company B and company C. Right? So what is our x1? Our x1, our good examiner is telling us that I'm having working capital over total assets. Go to your company A. Company A, look at working capital. We are given 4,000. So basically I'll be having here company A. I'm having 4,000. Divide by working capital. In this case, I should be talking of what? Our working capital is 4,000 over total assets. Total assets is 200,000. What about x2? X2, we are told that it is retained earnings over total assets. So look at your retained earnings. Your retained earnings, basically in this case for company A, I'm having 60,000. Our total assets, you can see it will not change, simply 200,000. Talk about x3. X3, I'm told I'm having earnings before interest and tax over our total assets. So earnings before interest and tax for company A, I can clearly see I'm having 10,000 here. Of our total assets, in this case, I'm having what? 200,000. Just using what you're given. X4, our good examiner here has told us X4 is our total sales. Total sales, which in this case, my total sales, we're given 200,000. We divide by our total assets, which is 200,000. X5, we are having our X5, basically I'm having market value of equity, which market value of equity I'm given 20,000. We divide by the book value of debt. So where is our debt here? Where is our debt? Debt, of course, it is our liability. That is our debt, right? Our debt is our liability. So liability in this case, I was given a figure of what? 120,000. So I'm having 20,000 of our debt, which is 120. So that is our market value, 20,000 divided by 120. I'm just going to do for one company, actually. The rest you're going to do it for Mwalimu because the concept will just be the same. So what will be our X1 here? You see how simple this concept is. X1, I'll be having, I'm going to take my calculator. X1, I'm having 4,000 divided by 200,000. This should give us 0.02. X2, 60,000 divided by 200,000. This will give us 0.3. X3, 10,000 divided by 200,000. This should give us 0.05. This should give us 1. 20,000 divided by 120,000. This should give us 0.17. So these are our values for our financial ratio that we've computed. So therefore, I can determine my Z for company A, right? Our Z for company A, we should be talking of what? Z for company A, therefore, I should be talking of 1.2 times 0.02. We add 1.4 times 0.3. We add 3.3, right, times 0.05. We add 1 times 1. Then finally, we add 0.6 times 0.17. This will give us a score of, what? I'm having 1.2 times 0.02. We add 1.4 times 0.3. We add 3.3 times 0.05. We add 1 times 1. We add 0.6 times 0.17. This will give us a score of 1.711. Right? That will give us a score of 1.711. Kindly, my good students, confirm if we are getting the same concept. So that now this should take us to our interpretation, which should be very key. So anytime you are supposed to basically interpret, of course, we are giving a chance. If at all, there could be a chance that this company basically will go to bankruptcy, or if it will not go to bankruptcy. So on interpreting this, these are what I want you guys to have always. On interpreting this, these are what I want you guys to have always. You can have it like in this context, the measure that you will always be using anytime you want to interpret. So I'm having basically that is of course 0 to maybe 0 to 1.8 score. We can have basically 1.8 score to 2.7 score, and 2.7 and above. So in our score, if we were to measure at any given point, whenever our Z score lies between 0 to 1.8, in this case, you'll find that at this point, this company basically 0 to 1. This company has a chance. There's a chance of failure. These are literally a very dangerous area. See this point here. The company has a chance of failure. There's a 100% chance of failure. There's a 100% chance of failure. There's a 100% chance of failure. Between a score of 0 to 1.8, there is a 100% chance of failure. Then if your score lies between 1.8 to basically aspect over 2.7 score, in this case, you'll find that you're in a gray area. So maybe 50-50, 50% chance. There's a 50% chance of what? Of failure. There's a 50% chance of failure. In that, you're 50-50, right? Term it as you are like in a gray area. You are in a gray area. But above 2.7, above 2.7, there's no chance that you're going to fail. There's zero chance that you're going to fail. Zero chance that you're going to fail. Zero chance that you're going to fail. So at any given point in time, whenever we are using our scores to measure, this will always be very, very important for us to always have in mind. This one will always be very, very important for us to always have in mind. Like, for example, if we can consider the Z-score for this was company A, you'll find that it lies between 0 to 1.8, right? It lies between 0 to 1.8. So we can agree that at this point, the Z-score here is below 1.8, right? So therefore, this company A, it has a very high risk. There's a very high risk of failure. There's a very high risk of bankruptcy for company A. There's a very high risk for bankruptcy for company A because the Z-score here is below 1.8. That is very important. That is very, very important for us to always have in mind. So literally, in this case, on interpretation, when you are talking of maybe this company, in this case, we can say that you'll find that it has a chance of failure. It has a chance of failure. So once you have that, I know you guys, you can do B. So for B, it's just a matter of copying and pasting, just the way we've done with A. I want you guys to do for B and C. And where you're having a challenge, of course, you can always reach out for Mwalimu to guide us. I've given you for A, you can do for B and C. The same concept applies. The same concept applies. To that point, you're going to do another question for Z-score again. You'll find that it will just be the same. So I'm believing that after this, there's no question for Z-score which you can't handle because I've given you the whole concept.